Why conviction faded without a sell-off? Nothing collapsed. No levels broke. No panic swept across screens. And yet, something essential disappeared from the market long before anyone noticed it was gone. To understand why this matters, we need to revisit a period when prices still held firm and headlines stayed reassuring. Markets appeared stable. Volatility behaved. Every traditional signal suggested resilience. But beneath that surface, conviction, the force that turned participation into support, was quietly draining away. Conviction isn't optimism. It's willingness. The willingness to act early, to absorb uncertainty, to step in before outcomes are clear. For years, that willingness defined market behavior. Dips were bought quickly. Risk was met with confidence. The system worked because belief filled the gaps between moves. The first reveal begins with behavior that felt harmless. Buyers didn't disappear. They simply arrived later. Support still formed, but it waited to see what would happen first. Capital no longer rushed to prove belief. It waited for confirmation. That delay felt prudent, rational, almost invisible. The second reveal came through repetition. Each small test reinforced the same pattern. Pullbacks lingered longer. Recoveries felt less decisive. No sell-off followed, so confidence and stability remained. But the absence of urgency wasn't strength. It was hesitation wearing the mask of discipline. The third reveal emerged when experienced participants noticed a subtle change in tone. Conversations shifted from opportunity to positioning, from conviction to optionality. Exposure stayed intact, but emotional commitment softened. Capital was present, but no longer felt responsible for holding the market together. That was the moment conviction began to fade, not because risk exploded, not because fear took hold, but because acting first stopped feeling necessary. The market didn't need a sell-off to lose conviction. It lost it quietly, one delayed response at a time. And once conviction weakens, stability becomes fragile, even if prices haven't moved yet. What followed would prove that markets don't fall only when people sell. They fall when people stop believing it's their role to step in. And that belief was already slipping away. As conviction thinned, the market began behaving differently without changing direction. Prices still hovered near familiar levels. Rallies extended modestly. Pullbacks recovered. To most observers, nothing seemed broken, but behavior had shifted in a way charts couldn't capture. The conflict emerged in timing. Buyers no longer rushed to defend levels. They waited to see if support was truly needed. Sellers sensed that hesitation and pressed a little longer, not aggressively, just enough to test resolve. That interaction, wait, press, wait again, became the market's new rhythm. Liquidity mirrored the change. It remained available, but it felt conditional. Depth appeared briefly, then stepped aside. Quotes refreshed cautiously. Market makers protected themselves not from volatility, but from uncertainty about response. Liquidity was still present, but it no longer felt committed. The tension deepened as this behavior repeated across sessions. Each successful recovery reinforced the belief that waiting was safe. Each delayed response trained participants to hesitate a little longer next time. Conviction didn't vanish overnight. It eroded through reinforcement. Institutional desks noticed the effect in execution quality. Trades took longer to complete. Slippage crept higher in places once considered dependable. Strategies reliant on fast absorption struggled quietly. Nothing dramatic happened, but efficiency declined steadily. Derivatives markets told the same story. Demand for protection rose during calm periods, not stress ones. Skew adjusted subtly. Traders weren't bracing for disaster. They were hedging the possibility that no one would step in when needed. Conviction risk had replaced price risk. The buildup continued as capital allocations subtly changed. New positions were structured with exits in mind. Time horizons shortened. Optionality became more valuable than commitment. These weren't defensive moves. They were adaptive ones. But adaptation, when shared broadly, reshapes the market. Veteran participants recognize the danger clearly. Markets can survive selling. They struggle with waiting. When conviction fades, liquidity loses initiative. And when liquidity loses initiative, Small imbalances travel farther than they should. The market still looked supported, but support had become passive. And passive support doesn't resist pressure, it responds to it. The quiet fading of conviction hadn't triggered a sell-off, but it had set the conditions under which the next test would matter far more than anyone expected. Because when conviction is gone, the market no longer moves forward with belief. It moves forward cautiously, hoping someone else will go first. And hope is not a strategy markets can rely on for long. That reliance was tested the first time uncertainty demanded a response instead of patience. A modest shock passed through the market, not a crisis, not even surprise, just enough to require someone to act with confidence. No one did. Prices dipped and waited. Buyers hovered, watching depth instead of providing it. Sellers tested further, sensing the absence. The familiar sequence, pressure, absorption, recovery, failed to complete, not because it was impossible, but because conviction was missing at the moment it mattered. The conflict intensified as hesitation fed on itself. Each delayed bid encouraged more selling. Each extension justified more waiting. The market wasn't afraid. It was undecided. And indecision, when shared broadly, creates instability without panic. Institutional systems reacted mechanically. Algorithms reduced aggressiveness when signals conflicted. Risk controls trimmed exposure incrementally, not because losses were large, but because uncertainty had grown expensive. These actions were logical. Together, they removed even more initiative from the system. The buildup accelerated as correlations tightened. Assets that normally offset one another began moving together. Diversification weakened quietly. Strategies designed to smooth transitions now amplified hesitation. The market grew heavier with each small move. Execution desks felt the strain clearly. Slippage widened. Timing became critical. Orders that once cleared smoothly now required careful placement. Liquidity existed, but it waited for confirmation before engaging. The system had become reactive instead of stabilizing. Veteran participants recognized the pattern immediately. This wasn't a breakdown. It was a vacuum, a space where conviction should have been. Markets don't collapse when everyone sells. They stumble when no one leads. As the session wore on, the absence became undeniable. Levels failed not from pressure, but from neglect. Support didn't break. It never formed decisively. The market adjusted downward not because fear arrived, but because belief didn't. That moment revealed the truth clearly. Conviction hadn't faded because the market fell. The market fell because conviction had already faded. And once that relationship flips, recoveries become harder, reactions become slower, and every future test carries more weight than the last. The final phase would reveal what happens when a market built on participation is forced to function without belief, and whether conviction can return once it has quietly stepped aside. The adjustment that followed wasn't violent, but it was decisive. Prices moved lower in a steady, deliberate way, as if the market were finally acknowledging what behavior had already been signaling. There was no rush for the exits, no fear-driven collapse. Just a quiet repricing in an environment where belief no longer filled the gaps. That was the climax. Not a sell-off, but a confirmation. The market revealed that conviction had been doing more work than anyone realized. Once it faded, stability became conditional. Support still existed, but it required proof before appearing. Liquidity still flowed, but only after direction was established. The system hadn't failed. It had changed. As volatility expanded unevenly, participants reassessed what had happened. Many searched for the moment things went wrong. A headline, a data point, a decision, but there was no single cause to point to. The real shift had unfolded gradually, invisibly, through behavior that felt reasonable at every step. The resolution emerged in how the market adapted. Capital returned selectively, but without urgency. Positions were rebuilt carefully. Time horizons shortened. Strategies prioritized flexibility over conviction. The system found balance again, but it was a different balance, one that no longer assumed belief would arrive automatically. What lingered was the lesson. Markets don't require selling to weaken. They require conviction to hold. When participants stopped feeling responsible for stepping in, Even calm environments become fragile. Stability isn't maintained by prices alone. It's maintained by willingness. Conviction doesn't announce when it leaves. It just stops showing up when pressure arrives. And once the market learns to function without it, everything moves differently. Reactions slow, recoveries weaken. Small shocks travel farther than they should, not because the system is broken, but because belief is no longer doing the unseen work that once held it together. Understanding this matters because it explains why markets can feel uneasy without obvious cause, why moves feel heavier, why support feels unreliable. It's not always about fear or fundamentals. Sometimes it's about the quiet absence of conviction. And the most dangerous part is this. By the time people notice it's gone, the market has already learned how to move without it. So what do you think? Are we watching conviction fade again right now, without a sell-off to warn us? Why